Hello students, I am Vipul Mittal and in this session I will discuss fraud. So you are the auditor and you're auditing the financial statements and you have to be reasonably sure that financial statements are free from material misstatement, whether those material misstatements are due to fraud or error. So you have to obtain reasonable assurance that financial statements are free from material misstatements, whether due to fraud or error. You are the auditor and it is not your responsibility to prevent fraud in the organization. It is not your responsibility to detect fraud, but you only have to obtain reasonable assurance that financial statements do not contain any material misstatement that is due to fraud or error. It is management's responsibility to prevent and detect fraud. You cannot prevent fraud or detect fraud. It is not your job. It is management's job. You may suspect fraud. You may even identify fraud, but it is not your job to identify fraud. You may detect a fraud. You may suspect a fraud sometimes. You have to maintain professional skepticism throughout the audit regarding fraud. So you have to remain alert for instances of fraud throughout the audit. There could be instances of fraud. You have to be alert to that throughout the audit. Maintain professional skepticism throughout the audit. So fraud is an intentional act by one or more individuals involving the use of deception that results in a misstatement. It is an intentional act to misrepresent the financial statements. It is an intentional act by individuals, one or more. This is an intentional act that involves the use of deception. And this results in a misstatement in financial statements. For example, cashier is supposed to have a cash of $20,000 in office. So $20,000 cash should be in the cashier's drawer. And this is cash in hand. This is cash balance as on December 31st, year 6. This should be the cash balance. But the cashier steals $15,000 and uses that for his personal purposes. Now, actual cash balance is only $5,000. $15,000 cash is stolen. So $15,000 cash is stolen. As per books, cash balance is $20,000, but actual cash balance in the cashier's drawer is $5,000 only. Can you say cash balance is misstated? This is what is appearing in the financial statement, and this is misstated because of fraud. It is an intentional act. This theft of $15,000 is an intentional act by the cashier. This results in a misstatement in the financial statement. So fraud is an intentional act by one or more individuals involving the use of deception that results in a misstatement in the financial statements. Now, this fraud may be classified into fraudulent financial reporting and misappropriation of assets. So you may classify the fraud into fraudulent financial reporting and misappropriation of assets. Now, this fraudulent financial reporting could be due to misstatement, Misstatements in the financial statements, it could be omissions in the financial statements. So management omits to record certain expenses so that net profit is higher. Management records fictitious journal entries to manipulate results. Management records fictitious sales to show higher sales and profits. Management engages in complex transactions, and this management does to misrepresent financial performance. Management make certain adjusting journal entries that are not appropriate. Management delays the recognition of revenue for certain reasons. Management conceal facts that have impact on recorded amounts. As a result, assets are overstated. So we are talking about fraudulent financial reporting. Financial reporting is fraudulent. Various elements of financial statements are misstated. Fraud may also happen due to misappropriation of assets. So here I'm talking about theft of entities' assets. I gave you one example on this, that there is theft of $15,000 cash by the cashier. As a result, cash balance is misstated in the financial statements. This is an example of misappropriation of assets. Other examples of misappropriation of assets could be that account receivable collected are misappropriated. So person who is in charge of AR collection misappropriates the collection. For example, if one of the customer A remits $2,000 to the organization, but the person collecting and recording this records only $500 and misappropriates $1,500. Collection is reported as only $500 when actually entity has collected $2,000. There is a theft of $1,500. Misappropriation of assets. It is a fraud. Theft of collection. Management uses organization assets for personal use. Fraud. Stealing inventory for personal use. Fraud. Another example could be that payment is made to vendor for goods not purchased. So payment of $5,000 is made to vendor, but the organization has not received any goods. No purchases are made from this vendor, but payment is made. Fraud. And you classify this as misappropriation of assets. All right. So you may classify fraud as fraudulent financial reporting and misappropriation of assets. And fraud is an intentional act by one or more individuals involving the use of deception that results in a misstatement in the financial statements. As an auditor, it is not your job to identify and detect fraud, but you may suspect fraud, you may even identify fraud, but fraud is more of a legal matter, and whether there is a fraud actually is a matter of legal determination. You cannot declare that there is a fraud. You cannot make a judgment that there is a fraud. It is more of a legal matter. You can only suspect fraud, sometimes even identify a fraud, but it is more of a legal matter. Your job is to obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error. All right, students. I hope this session was helpful. Watch more videos on fraud risk to get complete understanding. Goodbye. Take care.